Before the year ends, there are a few Social Security rules that quietly determine how much you'll receive in the months ahead. Missing even one of them can lead to lower payments, delays, or unexpected deductions in January. The problem is, most of these rules aren't clearly explained and rarely come with reminders. Today, we're breaking down the critical steps you still have time to check before December 31st. A few minutes now can protect the benefits you worked a lifetime to earn. Social Security benefits are calculated using a worker's lifetime earnings record, specifically the highest 35 years of indexed earnings. Each year of reported income contributes to the formula used to determine a person's primary insurance amount, which serves as the foundation for all future benefit payments. When an earnings year is missing or incorrectly reported as zero or significantly lower than actual wages, it can permanently reduce the benefit amount. Because Social Security does not automatically correct historical wage discrepancies, individuals must actively review their earnings history and address errors. December is an especially important time to do this, as correcting inaccuracies early helps ensure benefit calculations are accurate before annual adjustments and notices are finalized for the new year. Beyond earnings accuracy, December represents a critical evaluation period for individuals who have not yet claimed benefits or who are reconsidering their claiming strategy. The decision to claim early at full retirement age or to delay benefits up to age 70 has long-term financial consequences. Delaying benefits increases monthly payments through delayed retirement credits, while claiming early results in permanent reductions. Year-end income, health considerations, employment status, and spousal benefit coordination all influence whether an existing plan remains optimal. Reviewing these factors before the year closes allows individuals to make informed adjustments before benefit payments or eligibility milestones take effect in January. For individuals receiving benefits while still working and who are below full retirement age, annual earnings limits are another critical consideration. Social Security enforces an earnings test that can result in temporary benefit withholding if income exceeds the established threshold. Many beneficiaries are surprised to see reduced or suspended payments in the new year because their earnings crossed the limit late in the previous year. This withholding does not eliminate benefits permanently, but it can create short-term cash flow disruptions and confusion. Monitoring income totals, accurately reporting earnings, and understanding how the earnings test is applied allows beneficiaries to anticipate potential adjustments and avoid unexpected reductions. Addressing these issues before December 31st provides clarity, protects cash flow, and supports better financial planning as the new year begins. Year-end income totals play a decisive role in determining whether Social Security benefits are subject to federal income taxation. The Internal Revenue Service uses a calculation known as combined income, which includes adjusted gross income, non-taxable interest, and one-half of Social Security benefits. When combined income exceeds established thresholds, a portion of Social Security benefits becomes taxable. For individuals, taxation begins when combined income surpasses $25,000, while married couples filing jointly face taxation starting at $32,000. As combined income rises beyond higher thresholds, up to 85% of benefits may be included in taxable income. Because these thresholds are not adjusted for inflation, more beneficiaries are impacted each year, particularly those with pensions, investment income, or part-time earnings. The impact of Social Security taxation is often underestimated because benefits are paid monthly, while tax liability is calculated annually. A modest increase in income late in the year, such as capital gains, withdrawals from retirement accounts, or seasonal employment, can push combined income above a tax threshold. This can result in an unexpected tax obligation when filing, reducing the net value of benefits received throughout the year. Since Social Security does not automatically withhold federal income taxes unless requested, beneficiaries frequently discover the liability only when preparing their tax return, leaving little time to plan or offset the expense. Adjusting federal tax withholding before the year ends is an effective way to manage this exposure. Beneficiaries may elect voluntary withholding from their Social Security payments by submitting Form W-4V, selecting a fixed percentage to be withheld. Alternatively, withholding can be increased on other income sources, such as pensions or retirement account distributions, to cover anticipated tax obligations. These adjustments help spread tax payments evenly across the year, rather than concentrating them into a single bill at filing time. Proactive year-end tax planning allows beneficiaries to maintain predictable cash flow and avoid penalties related to underpayment. By reviewing income totals, estimating combined income, and aligning withholding levels accordingly, individuals can preserve the after-tax value of their Social Security benefits. Taking these steps before December 31st ensures that tax obligations are addressed strategically rather than reactively, providing greater financial stability in the year ahead. Payment continuity for Social Security beneficiaries depends heavily on the accuracy of direct deposit information on file with the Social Security Administration. During year-end processing, systems update benefit amounts, apply cost of living adjustments, and implement Medicare premium changes simultaneously. If a bank account has been closed, merged, or assigned new routing or account numbers, payments sent in January may be rejected or delayed. Recovering misdirected funds can take several weeks, as the payment must be returned, verified, and reissued. Updating banking information before December 31st ensures uninterrupted benefit delivery at a time when administrative volume and processing delays are highest. Medicare premium adjustments further influence net Social Security payments at the start of each year. Standard Medicare premiums, along with income-related monthly adjustment amounts for higher income beneficiaries, are typically deducted directly from Social Security benefits. When these premiums increase, the deduction reduces the gross benefit before funds reach the recipient. Although cost of living adjustments may raise the base benefit, higher Medicare premiums often offset part or all of that increase. This interaction can create confusion when beneficiaries see a smaller net payment in January despite an announced benefit increase. Reviewing expected Medicare deductions in advance allows beneficiaries to anticipate changes and adjust household budgets accordingly. Income changes at year-end also affect eligibility for financial assistance programs that help offset healthcare costs. Programs such as Medicare savings programs and prescription drug subsidies use income and resource limits to determine eligibility. Even small income increases, such as higher benefit amounts, investment income, or temporary employment, can place beneficiaries above qualifying thresholds, resulting in the loss of premium assistance or reduced prescription coverage. Conversely, income reductions may newly qualify individuals for programs they previously did not access. Evaluating income totals and reporting changes promptly helps beneficiaries maintain or secure support where available. Coordinating benefit payments, healthcare deductions, and assistance program eligibility before the year closes minimizes disruptions and prevents avoidable gaps in coverage or cash flow. Proactive year-end review ensures financial stability as benefit structures reset for the new calendar year. Timely communication between beneficiaries and the Social Security Administration is essential for uninterrupted benefit delivery. Social Security routinely sends official notices related to eligibility reviews, income verification, Medicare coordination, and administrative updates. These notices are typically delivered by mail and often require a response within a defined time frame. If correspondence is sent to an outdated address or remains unopened, the agency may interpret the lack of response as non-compliance. In such cases, benefits can be temporarily suspended or delayed until the matter is resolved, even though the individual's underlying eligibility has not changed. Reinstatement may require documentation, identity verification, or in-person or phone appointments, all of which can take weeks or months to complete. Address accuracy is especially critical during periods of heightened administrative activity, such as year-end processing and the start of a new benefit year. At this time, Social Security implements cost of living adjustments, updates Medicare premium deductions, and conducts periodic eligibility reviews. Any interruption in communication during this period increases the likelihood of processing delays. Beneficiaries who move, change mailing preferences, or rely on third-party mail handling are at greater risk of missing time-sensitive notices. Regularly confirming contact information and promptly responding to requests ensures continued benefit flow and minimizes administrative complications. Cost of living adjustments are designed to preserve purchasing power by increasing benefits in response to inflation. However, these increases do not necessarily result in higher net income. Medicare. Part B premiums, income-related surcharges, and other healthcare-related deductions often rise concurrently with COLA adjustments. When premiums increase at a faster rate than benefits, The net amount deposited each month may increase only marginally or, in some cases, decline. This effect can be particularly pronounced for beneficiaries subject to income-based Medicare surcharges or those enrolled in supplemental health plans. Understanding how COLA interacts with healthcare costs is essential for realistic financial planning. Evaluating gross benefit increases alongside projected deductions provides a clearer picture of actual take-home pay. Proactive review of benefit statements and healthcare expenses allows beneficiaries to anticipate changes, adjust budgets, and avoid confusion when January payments do not reflect the expected increase. Accurate reporting of work activity and income is critical for Social Security beneficiaries who receive retirement, disability, or supplemental benefits. For individuals receiving disability benefits or supplemental security income, the Social Security Administration requires detailed reporting of earned and unearned income, including wages, self-employment income, and any changes in employment status. Failure to report income accurately can trigger overpayments, which the agency will later seek to recover, often with interest or penalties. Even minor discrepancies in reported work activity can result in significant repayment obligations, creating financial strain and administrative complications. December is an opportune time for beneficiaries to review year-to-date earnings, verify that all employment and income activity has been reported correctly, and make any necessary corrections before the new benefit year begins. For retirees receiving Social Security benefits, work activity can also affect payments if the beneficiary has not yet reached full retirement age. The earnings test imposes annual limits on income, and exceeding these thresholds may result in temporary withholding of benefits. Carefully tracking work activity and projecting year-end earnings ensures that beneficiaries can anticipate potential reductions and manage cash flow proactively. Addressing discrepancies before December 31st prevents unexpected withholding in January, which could otherwise cause confusion and disrupt financial planning. December is equally important for reassessing family and spousal benefit coordination. Social Security offers various options for spouses, ex-spouses, and survivors, and strategic claiming decisions can maximize household income over the long term. Reviewing these options at year-end allows beneficiaries to evaluate whether current benefit elections remain optimal in light of changes in earnings, health status, or family circumstances. Coordinating benefits effectively can increase cumulative lifetime payments, reduce potential taxation, and ensure long-term financial stability for both the primary beneficiary and family members who rely on spousal or survivor benefits. Taking the time to verify work reporting accuracy and review family benefit coordination in December positions beneficiaries to avoid overpayment issues, optimize household income, and maintain compliance with Social Security regulations. This proactive approach reduces administrative complications and provides peace of mind as the new calendar year begins. Proactive understanding of your Social Security and Medicare coverage is essential for maintaining uninterrupted healthcare access and financial stability. Reviewing your plan details before January ensures that you know which services, treatments, and prescription drugs are covered, as well as any requirements for prior authorizations, network restrictions, or cost-sharing obligations. Failing to review coverage in advance can lead to unexpected out-of-pocket expenses during medical emergencies, when timely decisions and treatment are critical. By examining your plan before the new year, beneficiaries can confirm that their preferred providers remain in-network, verify prescription formularies, and identify any changes in benefits that could affect care or costs. This preparation minimizes disruptions and ensures that healthcare needs are met without delay or confusion. Social Security and Medicare communicate important updates and administrative requirements through official mailings. These documents may include benefit statements, cost of living adjustments, Medicare premium notices, or eligibility verification requests. Understanding what to expect in these communications allows beneficiaries to detect errors early, such as incorrect income reporting, misapplied deductions, or outdated personal information. Promptly addressing discrepancies can prevent delays in payments, interruptions in healthcare coverage, or administrative complications that may arise if notices are ignored or overlooked. Maintaining accurate contact information and regularly reviewing mailings is a critical part of ensuring smooth benefit administration. Remaining informed about ongoing policy discussions and legislative changes is also vital for long-term financial protection. Social Security and Medicare programs periodically undergo modifications that can affect eligibility, benefit calculations, or cost structures. Staying up to date on these developments enables beneficiaries to anticipate adjustments, make strategic decisions about claiming or coverage, and safeguard their income against unexpected reductions. Regularly monitoring official announcements, consulting with licensed advisors, and reviewing plan documents ensures that beneficiaries maintain both healthcare access and financial security as regulatory and policy landscapes evolve. This proactive approach reduces uncertainty, mitigates risk, and allows for informed, confident decision making regarding benefits. Taking a few deliberate steps before December 31st can make a lasting difference in your Social Security benefits, your healthcare coverage, and your financial stability. By reviewing earnings records, updating contact and banking information, and understanding upcoming adjustments, you protect the income you've earned over a lifetime. Staying proactive ensures there are no surprises in the new year and positions you to make informed decisions as policies and programs evolve. Your future benefits are too important to leave unchecked. Act now and start the year with confidence and clarity.